this is gonna be my attempt at trying to explain uh, strategy and like confluences, just things you kind of need to know if you're a quote unquote beginner before like actually stepping in to trading. Just little terminology that you should be aware of, just to make you know process a whole lot easier. Because I remember when I started, I had a fat ego and I was like, oh, like I don't need to learn any of that stuff. Like I'll just learn straight on the charts and pray for the best. But obviously, that's not the way to do it. Well, bro, send me freaking Fortnite invites. But alright, made a little slide here. Futures trading for beginners, and this is just gonna go over like the most basic have to knows of trading and like strategies and confluences and just things you need to be looking out for and start seeing when you look at charts. So the first one is going to be fair value gap. Um, this could also be considered like a new dog or a new wog, and I'll kind of explain the differences shortly right now. But a fair value gap is basically just a gap in price formed by three candles. And then that gap in price should have like no touch in between. So if we made these three candles and we have this whole gap where price has yet to come into, that would be a fair value gap. But if, like, let's say this candle opened up all the way down here and left, a wick across this whole area and no gap in price, then that would not be valid um, fair value gap. And it's the same thing for both, bullish and bearish scenarios. So if it's going up and you leave a little gap in between three candles, it's a fair value gap. Same thing if you're going down. And then fair value gaps can be formed anywhere from like the 1 minute, 2 minute, 3 minute, all the way up to a 4 hour. And then new dog and a new wog is somewhat the same thing. They do have a bit of a stronger pull. Um, they're basically just gaps in price. So new dog stands for new day opening gap, and new wog is new week opening gap. So it's a gap made in price on a new day or at the start of a new week. Those usually have a little bit more of a pull, just because it's literally a gap in price that has yet to be touched at all. It's a little bit different, somewhat the same. After that, we have liquidity sweep. It's a pretty known, common term. I feel like probably the easiest one to understand. It's basically when price takes a significant low or significant high, and then the ones you really want to be looking out for, the ones that are a little bit more valid, would be like a 1 hour sweep or a 4 hour sweep. And then if you take a low, it would be considered a sell side liquidity sweep, or I think it's the opposite. If you take a high, it'd be sell side. If you take a low, it'd be a buy side. I'm not too I'm not too sure. Keep it a buck. I don't really use those terms, but I kind of just wanted to throw them out on here, just so you have them, because I feel like sometimes a lot of people have different um names for stuff. So if you like try to look at other things, you might hear like, "Oh, we had a sell side sweep," and you're gonna be like, "What the heck is that? I don't know what that is." It's basically a glorified term for liquidity sweep on either high or low. It doesn't. You don't really need to know which is which. Just be aware of what a liquidity sweep is. And the third one, in my opinion, the most important one, is an S&T. So an S&T is like basically a divergence or difference in correlation of like where price is, right? So um, let's say we're going down one asset, for example, and Q takes a low, ES doesn't, right? That would be a bullish S&T because NQ already took this low and ES failed to, right? That would be an S&T at the lows. This could be a sign of a potential reversal or pullback up into price, since it's a bullish S&T. And same thing goes for bearish, right? So if NQ takes a high and ES doesn't, that would be a bearish SMT. And then vice versa, right? So if NQ doesn't take this low, but ES does, it's more of a it's a bearish SMT, because the way you want to think about it is ES is the road and NQ is the driver. So you want NQ to be taking the highs or lows if you're going to execute on NQ, right? So if you're trying to take longs, you're trying to take buys to the upside, an SMT with, NQ taking a low, aka liquidity sweep, ES doesn't, you have a bullish SMT. Now, something I want to touch on, that I didn't add on here because it's pretty simple to understand. Another big term is like an inverse fair value gap. So IFVG would basically be if, like, let's say you're trying to take sells, right? You're trying to take something in the downside. If you have these 3 candle formation and the next candle simply sweeps through this gap and closes below either this candle or this candle, that would be an inverse fair value gap. And it would also be like a change of structure, or a CISD, like a change in state of delivery. Probably should have added those, but it's basically just a change in direction. And obviously, the higher the time frame, the more important, the more relevant they could be. So like another thing I also probably should have added, you're gonna see a lot of fair value gaps. Not all of them are important, right? If I think like something you can get stuck on is if, like, oh, you see a 1 minute fair value gap and you blow right past it, um, you're like, oh, like maybe it's time to take shorts, right? But there's like a 5 minute bullish fair value gap right below it that gets touched, and then boom, you get freaking butt tickled, right? You get butt fucked. So yeah, not every gap is important. You only want to pay attention to these gaps if it aligns with, like a point of interest. Like, for example, let's say we just delivered off. Okay, let's say these are hourly candles, right? This is 3 hours, so 3 candles an hourly. Now you left this gap in price. The next candle comes into this area, starts rejecting, goes to the top side, breaks this high again. Now you have delivery off a 1 hour fair value gap. And obviously, when it comes to day trading, you're not going to be looking at hourly candles, right? You would be waiting for an hourly to come touch into this and either blow through it to signify that we might have a reversal in price, or respect this gap and continue to deliver higher. You don't always need to fill it 100%. Usually what I like to look for is at least halfway through the gap and see some sort of lower time frame, like either an inverse on the lower time frame, like on a 1 minute, 2 minute, 3 minute, to signify that we're going to respect this area and continue to deliver higher. For example, like, let's say again, same scenario. It's probably easier if I show you this on like a chart. Let's see. Okay, so for example here, right, we left 3 candles here. We left this gap. Just mark it out for the sake of. Left this gap here. This would be considered a bullish 1 hour gap, right? As you see, price comes into it multiple times and seems to want to trade away from it. Comes in again, trades away from it. Comes in again, trades away from it. Now, on this time, we do push all the way through it, but as you see, price still ends up respecting it and again pushing away from it. It's just like a prime example of using kind of fair value gaps as points of interest to want to start looking for like execution or take a trade, especially if it's like an hourly or 4 hour. They hold a lot more value than like a Say, and like all these little gaps here, all these would have been considered, 1 minute gaps at first, but as you see, you blow through them right away. Let's see if what day is this? 1639, Sunday, August 9. Okay, and here's why. This is why I kind of said that don't look at every fair value gap, because high time frame fair value gaps will end up being more powerful. And even though we had all these 1 minutes created um, on the bigger time frame, we had an S&T with NQ taking this high and ES failing to. Just kind of put this here so it's a little bit more clear. Right. So yeah, we had all these bullish fair value gaps, small time frame bullish fair value gaps, but we weren't in any real significant gap to actually deliver from. So you only want to use the smaller stuff when you have quote unquote permission from the bigger time frame, right? If it aligns with whatever way you're trying to take a trade. So let me see if I could show maybe like an execution. Also, just kind of throw this in here. Just kind of back to that same. Yeah, see, and at the time, we had a bearish S&T, and we were inside the smaller hourly gap to the left side. So price, even though price was still bullish, we were in a point of interest for price to want to retrace back into another hourly bullish time frame. So if you really think about it like this, like price is basically always just seeking to rebalance, right? You just want to be waiting for key areas for price to start maybe giving you the sign that it wants to, continue one way or another. In this example, we're extremely bullish, but we reach the point of interest where price is going to seek to rebalance. Now let's see if I can find. Okay, here's in my opinion, a pretty great example of day was this. Guess I could just. Okay, so here is kind of, let me go to bigger time frames. Look like gibberish. So here's kind of an example of price seeking to rebalance, right? This whole week we were just extremely bullish. Price was just shooting all the way up, and we had left all these gaps in price. We left the 4 hour here that we ended up pushing through. We did see some sort of fight and buys wanting to hold to go higher, but we evidently kept going lower into this next 4 hour. So now we're still in bullish gaps, even though we're going lower. We went lower all night. Obviously, if you look at the bigger picture, we're just straight shooting up. We still have a lot of price to, go to. There's these triple highs, which is kind of another thing that eventually you'll start picking up on. Like, this is basically a fat area and where price is gonna eventually come back, right? Because we have one, two, three times that price came up into this area and just rejected. So that means there's a lot of money in this area that if, like, for example, we want to come up all the way here, take it all out and then go lower, or just shoot past it and shoot for these highs, right? And as you see here, even though this isn't a clear reversal, we eventually came up into the area again, fourth time, shot back down. And then this is where bias kind of comes into play, right? In these candles, there's no real significance of a true reversal, right? There's no SMT. It's both indices or correlated. They're doing the exact same thing. So what does this tell me, right? This tells me that price is just seeking to rebalance. This is a manipulation of all this price to keep going higher. So now that we tapped into a new 4-hour gap, we want to look for a heavy sign of rejection to continue the bias to the top side. Get rid of this. So on this day, Thursday of last week, price came in right into half point of this fair value gap and immediately rejected it. This could be considered like a rejection block or an order block. It's just basically price telling you that that's it. Like, I'm good. I'm ready to continue the actual trend. I'm done, rebalancing. Another thing that I like to use that probably shouldn't throw in just yet because it might throw you off. I know when I talk about this stuff to like my friends that trade on the daily, they kind of hyper focus on it too much and end up trying to use it everywhere, or they use it incorrectly, and it just ends up being not useful. If anything, it ends up confusing them more. But for the sake of the video, so I use this tool, which is called Fibonacci tool. Basically, just pinpoints from highs to lows. Like, let's say we're going from a low to a high, right? This low to that high. If we were to try to take longs again to the top side, we would want to be under the 0.5 mark, right? Because that would be halfway through, aka equilibrium, aka in the discount part of this range, right? So you don't want to take longs above 0.5 because that would technically be still in premium, right? So if you're going to take longs, you want to be in discount. If you're going to take shorts, you want to be in premium. All right, so anything under 0.5, anything under this mark, you see it kind of just keeps going down from our highest part. Just anything under this just keeps going down. Here we're at 0.5. Even though this wasn't the true reversal, we still got a little bit of tension, right? Anything under 0.7, you see that this is the lowest you could possibly go, right? If you blow past these lows and keep going lower, then you got to redraw it, find a new pinpoint. Maybe you could have done something like this all the way up here, but you would have been waiting days, right? We're trying to take a trade today, not next week. So now that we have all this movement, we have sort of rebalanced through the night, through Wednesday as well, we started going lower, even though we had no real reason to go lower. It's just price simply wanted to seek rebalance. Came up into this 4-hour, hit EQ of the fair value gap, 4-hour fair value gap, and we were below 0.786, so in discount of this total range. Basically, you had 1, 2, and then the 5-minute rejection block. You had 3 confluences here telling you that price is either ready to go higher again, or just, if we're still going to go lower, maybe seek a rebalance of this to continue even lower. right? So you basically just want to put yourself in a position to have probability of it going your way, even if this isn't the bottom and we go all the way up after this, or we don't go all the way up after this. You at least want to put yourself in a position to at least catch something, right? So now that we have all this, right, we have 4 hour bullish gap and discount and a 5 minute rejection block. Now we have heavy signs of price wanting to go higher. Why? The chart is telling us to. We're not trying to force anything. We're not trying to, oh, we're just gonna take longs anywhere, right? We have probability. This is a game of probability. Like, you just want to seek the easiest trades, the most trades that you'll be like, oh, if I don't take this, like, it's free. It's free. This was basically free, right? So now if we think about, like, get rid of all this crap. So now you could have caught something down here. I did, but I was a little bit more confident, or, pretty sure. Because, okay, so here, price opens up, manipulates slightly higher, continues lower, we hit EQ. What do we make here? We make, back up here. We make a 1 minute fair value gap, right? So if this is the part where price wants to continue higher or reverse to the upside, we want to see these gaps get ran through and closed above the gap. So, like, for example, let's say we have a candle that comes in here, we create a wick and continue lower to take this low again, then that would be, we'd still be respecting the bearish narrative to go lower. But as you see here, price immediately just runs through this with, momentum, which is a really, really good sign. Yeah, that was just kind of my execution that day. Just could have also taken this 2 minute. So here's another thing too, like let's say you have a 1 minute fair value gap, but you also have a 2 minute. There wasn't a 3 minute. So your 2 minute would be your highest fair value gap that you want to see get inverse. So I would have been looking for an entrance on the 2 minute. As you see here, this just runs all the way through it. Which is why I took this 1 minute as soon as we were up above here. So let's say you get in somewhere like this, right? This is where you get your entrance. Put your stop at this low, because if this rejects and it comes back lower, then you're wrong, right? You were just wrong. You weren't right. Simple as that. Sometimes you just gotta bite those losses and just keep looking for another position. But yeah, let's say you have all that stuff to back up an entrance. You come down all the way down to the 1 minute. You find this entrance here. You take this. Now what do you want to do? Now you could either go for the easiest, which would be, 1-on-1 risk to reward. So if you have a 60-point stop loss, which is pretty big, I wouldn't have taken this, but just as an example, you want to shoot for 60 points up. Now, if you're really confident with this amount of momentum, you probably could have taken this higher, right? For like a 1 or 2. Now, here's the thing. Let's say you get up into like this area here. There's a lot of gaps here. Price could literally reject off any of these and shoot down. This is also a 15-minute gap. We could have came into here and shot back down. Another 15-minute gap up here. But why would we be able to hold this? Because we have this huge narrative behind what we're taking, right? We came into 4 hour. We came into discount of the range. We have this fat 1 minute inverse. We see that price in general is, we're not just going to dump all of this. Like, that's, if we just go up and down, up and down, up and down the whole time, like everybody would be rich, everybody would be able to do this. So we got to build an edge. We got to build the sort of narrative behind what we're doing. We see that we're still, bullish to the upside. We have four things to back up that this is a good area for us or for price to seek going higher. So we build confidence. We build, narrative. At this point, if you're really confident, you can go for something like a 1 and 2. Right? Let's say you're risking $500 here. The profit would be 1K or a rack. This obviously just runs through all this and just goes up because we had the narrative to back us up. And yeah, I mean, I guess that's kind of as simple as I can make it, bro. Like, basically just building a narrative behind price and just understanding it well, which obviously doesn't come with ease. Like, it just takes time to really understand it. It's another thing I probably shouldn't throw into here too much. This was my original target, which is true day open. Basically, just midnight on the Eastern time, New York time. So for us, it would be like what 9 p.m. Yeah, so for us, it's 9 p.m. It's basically the true point in a new daily candle. Oh, there's another thing. New daily candle that you could target. Yeah, well, like look at this. Like, we're obviously still going to the upside. This candle closed with no wick above it, so it's not, in my opinion, not a true reversal. So that's why I was kind of confident that day. After we basically just kept going lower all day or all night, that New York Open would continue the true trend of the market. Also, no S&Ts up here, nothing to really back us up from, continuing lower from here. Just had to wait for, a point in price where it would be to our advantage to seek probability there and take a trade with the trend, which was to the upside. And obviously, all of that could be used the opposite way, right? Like if it's a bearish trend, you would look for a pull back into the higher part of the market, which would be in premium to continue to take a short. This is a new WOG. It's a gap in a new week in price that we filled completely and just shot up from there. But you could take trades to new WOGs or away from new WOGs, right? Like if you wanted longs here to continue all this long, you would have waited for this to get filled, because if not, price is going to be seeking it and then just long from there. But yeah, hopefully that was somewhat easy to understand and somewhat beneficial. If you got any questions, just let me know.